Hey everyone, welcome to This Explainer. Today, we're tackling a financial dilemma pretty much all of us run into at some point. You want your money to grow, you know it needs to be working for you, but you absolutely despise those stomach-churning drops of the stock market. It's a tough spot to be in, right? But today we're going to break down an essential guide to a financial tool that might just be the perfect fit for your portfolio.
So, you want returns, but without the wild risks associated with stocks. For a lot of savers, it feels like there are really only two extremes. You either lock your cash in a vault where it barely grows, or you throw it onto the wild roller coaster of equities. But what if there's a middle path for your money? A smart, strategic option that positions you comfortably away from those high-risk stocks, but also keeps you out of those frustratingly low-yield savings accounts. To get us there, we'll quickly map out the alternatives, unpack what a debt fund actually is, look at the big benefits, uncover the hidden risks, and figure out exactly who this strategy is built for. Let's get right into it.
Starting off with finding that elusive middle ground. You're probably super familiar with the classic saver's dilemma. On one hand, you've got traditional savings accounts. Super safe? Absolutely. But the returns are, well, tiny. Your money is just sitting there, and honestly, inflation is probably eating away at its purchasing power. On the flip side, there's the stock market. The potential for high returns is huge, but the risks are right up there too. The market can tank just as fast as it peaks, and if you're a conservative investor, that level of volatility is just way too stressful. It totally leaves you feeling stuck between a rock and a hard place.
So what's the solution? Let's unpack the debt fund. The absolute most crucial thing to understand is what this vehicle actually is. At its core, a debt fund is just a type of mutual fund. But instead of buying shares of stock in companies, your fund manager takes your pooled money and invests it in fixed income securities. We're talking about things like government bonds, treasury bills, corporate bonds, commercial papers, which is really just short-term corporate debt, and certificates of deposit. Honestly, just think of all these things as a giant collection of IOUs. You're basically lending money to governments and corporations, and in exchange, they promise to pay it back with interest. The whole goal of pooling these specific investments together is to generate a regular, steady income, but with a drastically lower risk profile than the stock market. To make this super concrete, let's compare a debt fund to something you probably already know inside out, the traditional bank fixed deposit. When you drop your money into a bank FD, you're essentially lending your cash to just one single bank, right? And they pay you a set interest rate in return. Well, a debt fund works in a very similar spirit, but it comes with a massive upgrade in diversification. Instead of lending to just one bank, your fund manager takes that same money and lends it out across a huge diversified portfolio of different bonds and debt instruments from all sorts of issuers. It's the exact same core concept of lending for interest, but spread out to seriously manage your risk.
Okay, so why should you actually choose a debt fund? Let's look at the benefits.
These perks really show why debt funds have become such a game changer for focused investors. First off, you're completely shielded from those wild daily swings of the equity markets, giving you a much lower risk profile. Second, you get the potential to earn better returns than your basic everyday savings account. But here's the real kicker: professional fund management. You don't have to go out and manually pick which corporate bonds or treasury bills to buy. You've got experts doing all that heavy lifting for you. Plus, they're highly liquid. It's incredibly easy to invest your money and just as easy to redeem it when you need cash. Add all that up, and they become a phenomenal tool for your short to medium-term financial goals.
But listen, lower risk definitely does not mean zero risk. Let's talk about the hidden risks.
We've got to hit on this vital warning straight from our sources, and it's a big one. Returns are not guaranteed. Period. This is the fundamental difference between a debt fund and your standard bank fixed deposit. With a bank FD, you know the exact percentage you're getting back. No surprises. But with a debt fund, there is no absolute guarantee. You are actively trading that absolute certainty for the potential of a higher yield.
To break it down, there are three main risk factors you absolutely have to watch out for. First up is interest rate risk. Think of it kind of like a seesaw. If the broader economy's interest rates go up, the value of the older, lower-paying bonds in your fund actually goes down. Second is credit risk. Remember how we said you're buying IOUs from corporations and governments? Well, there's always a small chance that an issuer just fails to repay its debt. If they default, the fund takes a hit. And finally, general market conditions. Economic shifts in broad market sentiments can, and absolutely will, cause your returns to fluctuate over time. So it's a much smoother ride than stocks for sure, but it is definitely not a flat, motionless road.
All right, so who is this actually for? Let's run through the checklist.
Ask yourself if this sounds like you. Do you definitely prefer lower risk? Are you looking for stable, relatively predictable returns? Is your investment timeline anywhere from a few months up to maybe 3 to 5 years? And you want a solid alternative to fixed deposits that might give you slightly higher returns? If you're nodding your head right now, you are literally the exact investor debt funds were designed for.
But hey, before you just jump right in, a quick word of caution. You really can't just pick a debt fund at random. There are tons of different types out there. You have to dig in and really understand the fund's specific objective, its risk level, and its exact investment strategy before you put a single dollar on the line. Always know exactly what you're buying.
So, I'm going to leave you with this final question to ponder as you review your own portfolio. Are debt funds the right fit for your conservative goals? Only you can answer that by weighing your need for growth against your own personal tolerance for risk. I really hope this explainer gave you the clarity you need to evaluate this middle ground of investing. And, as a quick reminder, this content is strictly for educational purposes and should not be taken as financial advice. Always consult a qualified financial advisor before making any big investment decisions. Thanks so much for joining me to unpack the mechanics of debt funds, and happy learning!